Ever since ChatGPT burst onto the scene, the entire AI investment story has been dominated by GPUs. NVIDIA captured all the money in AI. Its market cap exploded to become the largest company in the world. CPUs? They were just the cheap component bolted onto AI servers as an afterthought. A cyclical business that spent a decade getting its valuation squeezed lower and lower. Then, April 2026 happened. After market close on April 23rd, Intel dropped a bombshell earnings report. Q1 revenue hit $13.6 billion, a sixth consecutive beat. The data center and AI business brought in $5.1 billion, up 22% year over year. Intel's stock surged 20% overnight, then another 10% the following week. A few weeks earlier, on March 24th, ARM took the stage at its own conference and announced a 136-core AGI CPU. ARM's own data made the case. Traditional AI data centers need 30 million CPU cores per gigawatt. Agentic AI needs 120 million, a four-fold jump in core density. AMD's stock has already climbed 60% since early April. A CPU supercycle is arriving. In this video, I'm going to walk you through a few things. First, why this CPU cycle is the real deal and why it's not just a short-term pop. Second, a full picture of the supply chain so you can see all the major players and where the money flows. And third, a deep dive into the specific stocks I think have the best opportunity right now. Let's get into it. Let me paint the picture. When you type a question into ChatGPT, it's a simple round trip. Your prompt goes in, the GPU does the heavy math, tokens come out. Linear pipeline. CPU's only job? Basic I/O routing like a traffic cop. In traditional setups, one CPU for every 4 to 8 GPUs forgotten. Now here's the shift. AI agents don't run like queries. They loop, plan to call a tool to parse the result, to reflect, to replan, to execute, to repeat. Serial, branchy, constant context switching. That's exactly what CPUs were built for. Run hundreds of agents at once, and suddenly you need a lot of cores. The market is just starting to price this in. Here's the stat that should get your attention. In traditional AI deployments, the CPU to GPU ratio is roughly 1 to 4 to 1 to 8. Lots of GPUs, not many CPUs. In agentic AI deployments, that ratio is shifting toward 1 to 1 or even 1 to 2. Some analysts think we'll flip to 2 to 1. More CPUs than GPUs in a cluster. Think about what that means for CPU demand. This isn't a short-term blip. This is a structural change baked into how agentic AI actually works at the architectural level. And it's just getting started. Let's talk market size. The server CPU market has been a sleepy $15 to $20 billion industry for the past decade. Classic, boring, cyclical stock territory. Morgan Stanley just put out a note saying this market could expand 4 to 7 times over the next 5 years, driven almost entirely by agentic AI demand. Now, that's not just growth. That's a massive re-rating event. CPU is transitioning from a boring cyclical to a genuine growth story. And the market hasn't fully priced this in yet. That's the opportunity. Here's the third piece of the puzzle, pricing power. In Q1 2026, both Intel and AMD started raising prices on their major products by 15%. They added a separate 10% surcharge on SKUs shipped to China. When companies can raise prices and customers keep buying anyway, that's a seller's market. Supply is tight. Demand is structurally growing. Pricing power is one of the clearest signals that an industry has entered a super cycle, and that's exactly what we're seeing right now. The CPU supply chain has 6 layers, and every single one benefits from this cycle. Layer 1, CPU design, Intel, AMD, ARM. They design the chips. Layer 2, custom silicon, AVGO, and MRVL. They build custom chips for the hyperscalers. Layer 3, fab and packaging. Layer 4, EDA and test equipment. Layer 5, memory layer 6, interconnect, power, and cooling. Today we're deep diving the first 2 layers, but where the most investable, high conviction plays live. At the top of the stack are the CPU designers. In the server market, it's basically x86, Intel, and AMD fighting for share, while ARM is staging a serious invasion from mobile into the data center. And x86's advantage is ecosystem compatibility, decades of software and enterprise workflows built on it. ARM's advantage is power efficiency, 2.2 watts per core versus Intel's 3.9. In a world where data centers are trying to pack more compute per kilowatt, that gap is a massive deal. Here's the key insight. Both x86 and ARM win as Agentic AI drives demand for more cores. And this isn't zero-sum. Here's a layer most retail investors miss. The big hyperscalers, Google, Meta, Microsoft, Amazon, don't want to buy NVIDIA chips forever. They want their own custom silicon, cheaper, tightly coupled to their software, and supply chain independence. But building a chip from scratch is insanely complex, so they hire AVGO and MRVL to do the heavy lifting, designing custom ASICs, working with fabs, managing packaging. AVGO owns 60 to 70% of this market. MRVL is the fast-growing number 2. With one unique edge, NVIDIA just invested $2 billion in them. That's NVIDIA blessing MRVL's chips to work natively inside the NVIDIA ecosystem. Nobody else has that. Manufacturing is where rubber meets road. TSMC is basically a monopoly, but not just for GPUs, but for CPUs too. Intel is the only advanced domestic alternative in the US, which gives it enormous geopolitical value beyond just being a chip company. Key data point: TSMC's Q1 2026 earnings showed AI-related chip revenue up 153% year over year versus just 35% for the company overall. That gap is the clearest upstream evidence of just how intense the capacity crunch is. TSMC's 2 nanometer and 3 nanometer capacity is already booked solid through 2027 and 2028. And if you want advanced chips, there's basically one place to get them. That's both the constraint and the opportunity. EDA, electronic design automation, means synopsis and cadence. Every single new chip that any company designs has to pay these guys for their software tools. No exceptions. ATE, automated test equipment, means AMAT and Advantest. Every chip that comes off the fab line gets tested before it ships. Period. So it doesn't matter who wins the chip wars between Intel, AMD, ARM, or NVIDIA, get paid either way. That's the most stable, lowest drama position in the entire supply chain. Memory is running its own supercycle right alongside CPUs. Think of it as the CPU's working memory. Like in the old days, context windows were a few thousand tokens. In the Agentic AI era, they're stretching to millions. The DRAM pool a CPU has to manage is growing exponentially. That's why even after memory stocks have already had massive runs, a lot of people are still bullish. Key names: Micron, SK Hynix, Samsung. But that's a whole separate video. Let's keep moving. Power, cooling, and interconnects. Winners forced into existence by raw physics. AI rack power is going from 100 kilowatts to 250 plus kilowatts by 2028. The ARM AGI CPU pulls 300 watts per chip. Intel Xeon 6 Plus is at 450. AMD EPYC Venice is pushing 500. These numbers mean the entire power, cooling, and interconnect infrastructure has to be rebuilt from scratch. Who wins? Vertiv for cooling and power, Delta Electronics for power, Amphenol, and Molex for interconnects. Now let's get into the individual stocks. I'm going to walk through 5 companies: Intel, AMD, ARM, Broadcom, and Marvell. For each one, I'll cover 3 things: where they stand today, what upside is still on the table, and what I actually think you should do with the stock. Let's start with Intel. The stock has been on an absolute tear, ripping higher from what were historically depressed levels. Here are the Q1 2026 numbers. Revenue, $13.6 billion, up 7% year over year, beating the guidance midpoint by $1.4 billion. DCA, revenue $5.1 billion, up 22% year over year. AI-related business is now 60% of total company revenue. ASIC run rate crossed $1 billion, up 30% quarter over quarter, nearly doubled year over year. 2 landmark deals happened in Q1. First, Google signed a multi-generational Xeon contract. This is the first long-term Xeon deal in Intel's history. That's a big deal. Second, NVIDIA selected Xeon 6 as the host CPU for the DGX Rubin platform. CPU is already delivering, but Intel's real re-rating engine is the foundry business. TSMC's 2 nanometer and 3 nanometer capacity is booked out through 2027 to 2028. The entire AI industry is facing an uncomfortable reality. Everyone needs advanced process nodes, but there's basically one supplier. Geopolitical risk, supply chain diversification pressure, US domestic manufacturing policy. These forces are quietly transforming Intel Foundry from a money-losing liability into the scarce domestic alternative to TSMC. Worth noting, 16% of Intel's float is locked up by strategic capital at under $24 per share, the US government at 10%, NVIDIA at 4%, SoftBank at 2%. That's not just financial backing. That's a signal about Intel's strategic importance that the market hasn't fully processed. The way I think about Intel right now, stop asking whether it can return to its 2010 glory days. The question is whether Intel can become America's domestic answer to TSMC. If it can, current market cap is still undervalued. Catalyst density is high over the next 12 months, 18A progress updates, 14A external customer announcements, Clearwater Forest production ramp, Diamond Rapids launch, and whether Q4 2026 free cash flow turns positive. That said, Intel is the highest risk name among these 5. The thesis depends too heavily on a single point breakthrough in 14A/18A. Financials are still messy. One execution delay and the stock could give back 30 to 40% fast. My take, I wouldn't chase above $80. A pullback to $60 to $65 is a more comfortable entry. If macro panic or a slight Q2 miss pushes it below $50, that's a genuinely attractive buy point. Next up, AMD. The stock is up 260% over the past year, and the PE has stretched to a staggering 133 times earnings. So, is this a sign the trade is getting overheated? AMD's position in this CPU supercycle is crystal clear: steady x86 server CPU share gains against Intel, plus being the second source AI GPU provider. EPYC server CPU share has climbed from under 5% in 2017 to about 28 to 29% by end of 2025, and Lisa Su has publicly said the target is 50% plus. Q for 2025, data center revenue $5.4 billion, up 39% AOI, up 24% QOQ, MI350 ramping better than expected. Key upcoming product is EPYC Venice, Zen 6 architecture, TSMC N2, up to 256 cores / 512 threads, PCIe Gen 6, that's a monster. Intel Diamond Rapids drops SMT, which gives Venice a real core count advantage. On the GPU side, ROCm hitting CUDA 80% parity is a genuine milestone that opens up way more workload opportunities. AMD's re-rating upside has mostly already been priced in. Everyone knows the story by now. Over the past 7 weeks, AMD is up 65% from $188 in early March to $305 on April 23rd. RSI at 83.6. That's not just overbought, that's historically extreme. 12 consecutive up days. SMA 50 deviation at plus 39.5%. Here's the valuation thing that really stands out. AMD's forward PE is now 27.8 times. NVIDIA's is 17.8 times. AMD is more expensive than NVIDIA, and AMD's growth rate is plus 27% versus NVIDIA's plus 73%. The OpenAI 6 gigawatts plus Meta 6 gigawatts commitments are real positive news, but that's already been absorbed by the market. At these levels, AMD looks like a sell the news candidate to me, not a buy the dip one. AMD has the cleanest fundamentals of the 5. Strong growth, healthy cash flow, zero debt, clear roadmap, no drama. But clean fundamentals don't mean you buy at any price. This is not where you start building a position. So AMD is on my watch list, not my buy list right now. My playbook: don't initiate above $300. If you hold core positions, keep them. But consider trimming 20 to 30% above $330 to lock in gains. A pullback to $250 to $265, Fibonacci 38.2% retracement, is where I'd start a small position. $220 to $235, Fibonacci 61.8%, is my core buy zone. ARM is the company I most want to hold for the long term. ARM-based CPUs are going to keep expanding. That's not a question. The edge AI inflection point is coming, almost certainly. And ARM is the cleanest, most direct way to play both of those trends. The only problem is that the stock is already very, very expensive. ARM's story has 3 layers. Layer 1, ARM-based CPUs, TPUs, and GPUs already own a massive share of AI data centers. This is already happening at scale. Layer 2, the AGI CPU is all about power efficiency. ARM's AGI CPU delivers 2.2 watts per core. Intel Xeon 6 is at 3.9 watts. In an era where data center power is the bottleneck, that gap directly determines how much compute you can pack into a rack. Layer 3, the edge AI inflection point. Billions of edge devices are going to need local AI inference. ARM is the dominant architecture for edge chips. Every new device that ships pays ARM a license fee. ARM isn't just a CPU design company. It's the most direct beneficiary of an entire data center architecture migrating toward ARM. And all 3 layers of its re-rating engine are still not fully priced in. That said, there's one major risk worth flagging. SoftBank holds about 90% of ARM's shares. If a margin call hits, you're looking at a massive short-term supply shock. And if the AGI CPU mass production slips to 2027, that layer 2 re-rating engine goes cold, at least temporarily. ARM is the stock I most want to hold for the long term. The CPU supercycle needs 24 to 36 months to fully play out, and ARM is the most certain beneficiary of the underlying architecture shift. My take: You can start a small watching position now. The ideal entry is $180 to $200. At the current price of $237, I wouldn't chase it, mate. But a small starter position to stay in the game makes sense. AVGO has the best fundamentals of the 5 companies. But great fundamentals don't mean the stock is cheap. $2 trillion market cap, up 121% in the past year, RSI at 77.8. It's just too expensive right now. AVGO is the dominant player in the hyperscaler custom chip market, a lane that runs completely separately from the NVIDIA GPU story. Alongside their NVIDIA GPU clusters, the hyperscalers are systematically building a second AI compute axis, custom SICs, XPUs, TPUs, MTIAs. AVGO owns 60 to 70% of that market. Their customer list includes Google TPU, Meta MTIA, ByteDance, OpenAI, and Anthropic. CEO Hock Tan said it straight on the Q1 FY26 earnings call. We have clear visibility to achieving over $100 billion in AI revenue in 2027. The business quality is excellent, but the story and the upside are already priced in. There's limited room to chase it higher. The average target price from 30 analysts is $443, only 5% upside from here. My probability-weighted price target comes out to $455, implying roughly 7.8% OKR. That's well below my 15% threshold for a long position. The most dangerous signal right now is the April 20th Marvel-Google partnership news. It's telling us that structural share shift could happen at any time. Good fundamentals don't make a stock cheap. Personally, I've lost interest at these levels. My playbook, don't chase above $400. First probe at $385 to $395. Add at $365 to $375 near SMA 20 plus Fibonacci 23.6%. Heavy buy at $340 to $350. SMA 50/200 dual support. Bull $580 plus 37%. Slash base $470 plus 11%. Slash bear $300 minus 29%. Position sizing 5 to 10% of tech allocation. AVGO plus NVIDIA combined no more than 25%. Marvel is probably the most undervalued company of the 5, and even at the current price of $165, I still think MRVL is the most asymmetric long opportunity in this group. Marvel's core business has 3 layers. Layer 1, custom XPU and optical DSP, dual engines. Marvel is one of only 2 companies in the world that can deliver a full stack solution, custom ASIC, optical DSP, switch chips, and storage controllers all in one place. The other one is Broadcom, but Broadcom is more than 10 times bigger by market cap. Layer 2, NVIDIA NVLink Fusion changes the game. On March 31st, NVIDIA invested $2 billion in Marvel and built the NVLink Fusion partnership. Marvel's custom XPUs now natively work with NVIDIA's high-speed interconnect. Hyperscalers no longer have to choose between NVIDIA and custom XPUs. They can run both inside the same AI cluster. The market is still valuing Marvel like a commodity semiconductor parts supplier, forward PE around 30 times. But what you're actually getting is an AI infrastructure platform company growing at 30 to 40% annually, with a moat that keeps getting wider and a business that keeps expanding. Look at the valuation multiples. MRVL is by far the cheapest large cap AI infrastructure name on this metric, and the forward PSG based on FY 2028 estimates drops to just 0.22, a clear signal that this growth stock is undervalued. On the right, you'll see 4 potential catalysts. Each one alone could trigger a 5 to 15% move. If any two of the four materialize, MRVL runs 25 to 40% from here. Even at $165, I still think MRVL is the most asymmetric long opportunity of the five. Look at NVIDIA and AVGO. Massive companies. Now look at MRVL. Same customers, same technology, same story, but the market cap gap is 10 to 20 times, and the valuation multiple gap is 5 times versus AVGO. That kind of discount doesn't last. It gets closed through catalysts. The CPU supercycle is going to bring a group of previously ignored companies, ARM and Intel, back into the mainstream. The full thesis needs 24 to 36 months to completely play out, and the AI megatrend is the most solid foundation it could possibly have. Tier 1, MRVL, Intel, and ARM. MRVL is the most asymmetric long-term opportunity. Intel is a high beta turnaround plus a foundry re-rating story on 2 tracks at once. ARM is the underlying architecture standard of the AI era. Tier 2, AVGO and AMD. Both have excellent fundamentals, but the story and the expectations are fully priced in. Only buy on a meaningful pullback.